What's up, YouTube? It's Yemi here again from SwingTradeFX. And in today's video, we're going to be talking about an important part of trading that is less discussed but has a very big impact on your performance in your trading, which is the best time frame for swing trading. Perhaps you're also a day trader. This video is actually very important for you, because a lot of traders lack clarity and they suffer a lot for this because they don't know what to look out for. What time frame do I need to look out for these things for? What do I need to look out for on this time frame? And because of that lack of clarity, it brings about uncertainty and it causes overwhelming or analysis paralysis. So maybe this is for you. You should sit back and relax and enjoy this video. But before we get into the video, I want you to be subscribed to this channel and click in the link below to join my free Telegram channel where I drop updates and trading nuggets, and I come once in a month to host free live sessions for all my community, which has really done a lot of impact in a lot of people's lives and their trading journey. So that being said, let's get into the video and let's go. So to understand the best time frame you use for swing trading or day trading, we need to be able to classify these time frame based on their functionality, right? And that is where it all starts from. You need to know the functionality of each time frames as a group before you know what to look out for in each time frame individually, right? So I want you guys to pay attention, right? So based on functionality, we basically have two types of time frame. We have the analytical time frame and we have the execution time frame. At the end of the day, everything we're looking for in the market is our ability to analyze, right? And find all those areas of interest we're looking for and be able to execute based on our strategy. This is the basic summary of Forex trading. So not to waste our time, let's go straight into it. For analytical time frame, it starts from definitely the higher time frame, which is the monthly time frame, right? Then we have the weekly time frame, then we have the daily time frame, then we have the 4 hours time frame, then we have the 1 hour time frame. So these time frames are grouped under analytical time frame because these are the time frames where you analyze, where you compare data, where you actually compare data against your strategy, when you look out for, the major tools you need to come up with your decisions for execution, right? And on the other side, we have the execution time frame. The execution time frame as the 1 hour, you can notice that the 1 hour is on this time frame too. That means you can use the 1 hour to analyze and execute as well. Then we have the 30 minutes and we actually have the 15-minute. Now let's go into what each time frame actually is used for. What do you focus on each time frame based on the data, right? Now you can realize that the monthly time frame has more of macro data, and as you proceed to the weekly, daily, 4 hour, 1 hour time frame, right, you amplify this data into micro data, right? And ability to connect the dots within this time frame is what helps you to make the right analysis, right? You want to be able to have a consistent view of what is going on the bigger time frame and connect it into the lower time frame until you get to your point of execution, which is right here. So to look at that, let's look at what the monthly time frame is used to look for, right? We use the monthly time frame to look for trend and range, right? When we go on the monthly time frame, there's higher chances that whatever trend you see on the monthly time frame actually shows the clear direction of where the market is going on the long term. Now, it helps you to position yourself in such a way that you are trading in line with the trend. And even when you're trading against the overall trend, you have it at the back of your mind that this is what I'm doing. You don't want to overstay your welcome in the market. Now, the weekly time frame is literally used to amplify what we see on the monthly time frame, right? Because 30 candlesticks or 28, as the case may be, make up the monthly time frame, right? The weekly time frame is going to break it down into weekly candles so we can see more details to actually establish the trend, and that is where we start to see the structures that make up this trend, because structures makes up trend, right? If you don't know that, you should watch my video on chart structures, right? And if you really want advanced strategies that I thought about, you should actually look to subscribe to my mentorship program, where I explain this concept deeply on how coordination turns into structures and this structures turns into trend, and how we can link them together in such a way that when you look at trend, you kind of know the backbone of what happens in that trend, right? I recommend it for everyone. Okay. Then we have the daily time frame, which is for identifying current structures, right? Notice I said current structures, right? The daily time frame is where you want to see what is going on right now in the market. What trend is the market doing right now, right? The bigger trend is on the monthly. You can amplify with the weekly, but the current trend that the market is moving on is most likely going to be found on the daily time frame. Okay. And once you understand the structure, the trend the market is moving on the day time frame, it's easy for you to be able to get their structures, right? Because each candle printed is a daily candle, right? Then the 4-hour time frame, you're looking for the areas of interest. Now, at this point, you must have been coming to a conclusion that since the current trend on the daily time frame is moving in this direction, right? The current structure is here. Perhaps this is the next pullback where the market is going to continue in direction of the trend, or perhaps this is where the market is going to get to before it starts to retrace against us, right? You want to be able to understand that on the 4-hour time frame. That's where you find your point of interest. That's where you find the point exactly where you can be looking forward to taking your trade from, right? The 1 hour also has a part-time job of actually helping you finding the area of interest, and also helps you to find execution, right? So if you're like a big trader, this is where it comes where we talk about like swing traders and day trader, right? If you're a very big swing trader, you can look forward to actually execute on the 1 hour. I see a lot of people execute on the 4 hour. It depends on your objective, right? I would not recommend that, right? The 1 hour entry confirmation is as good as the 4 hours, right? So the 1 hour, you want to use it to also establish your area of interest, to see it clearly, because now you're seeing more charts, you're seeing more candlesticks, and you want to be able to find your execution. The 30 minutes is strictly for execution, right? You use the 30 minutes for execution. If you're a day trader, perhaps, or you're a scalper, maybe this does not apply to you, but I'm talking of people that actually take trades and hold trades from periods of hours to days, right? 30 minutes is very beautiful for execution. And why is that? Because 30 minutes is very stable. Execution information or entry informations on the 30 minutes are usually very, very stable, right? It's not noisy. Unlike the next one, which is the 15 minutes time frame, where it is kind of like noisy. You're going to find a lot of noise right there. On the 15 minutes time frame, which necessarily might not just be the best thing, right? There are some times that you find a break and close confirmation on the 15 minutes time frame, and you find out that the market just faked you out and it start to move against you, right? You find out on 30 minutes that this was actually a weak rejection, or the 1 hour as a weak rejection. So I would recommend, right, that if you really want to trade in a very stable way, just stay on the 30 minutes time frame. At the end of the day, whatever information you see on the 15 minutes time frame will be reflected 15 minutes later on the 30 minutes time frame. Okay, so this is very, very essential for you to understand. So now that we know what this time frame does, I'm just going to give you a practical application to how we are going to be applying all of this in the market. So let's go onto the chart right now. So this is the GBP JPY. As you all know, I trade the GBP JPY, and this is it on the monthly time frame. So like we mentioned, the monthly time frame is used to understand the major trend, and is used to find our range. What do I mean by range, right? Range is just for you to be able to, you don't have to use all of this information that you see on the chart. You don't need all of this information, right? Once you are able to look at the current trend, you can find the range on which you're going to be using. You don't need to go into many years to be able to take a very good trade, okay? So now, in this case, what do we see right here? You can see right here that the current trend is to where? To the upside, right? And definitely you can confirm that by the reasons of what? Higher lows, higher lows, higher lows, higher lows, right? And this is the last high. So for us to be able to identify this range, it becomes very easy for us to say that, okay, this is the trend. The trend is going up, and these are just the last level that the market is rejecting, and this is the last range right here where the market is at, right? So it becomes so easy for you to understand the range where the market is moving. Of course, you want to be able to compare to previous data, maybe like previous area of resistance, strong support, and all of that, but those are conversations for all the days. And, I teach more of these advanced strategies in my mentorship program, which I recommend for everyone. Now, you've identified the trend, right? And you kind of note your data maybe on your journal to kind of have an understanding, right? That the trend on the monthly time frame is actually what is uptrend, right? And secondly, we're working within the range of the market around the 208 area and the 178 area. So this is the range. Every single information that we need next are literally just within this range, and we're going to be using whatever information that we find within this range to actually take our trade, right? Then the weekly time frame, like I said, is used to also establish this trend. So once you look at the trend clearly on the weekly time frame, you can see even much more details, right? You can see how the market has been moving on the higher low structure, and you can even see an even more recent structure within the range, right? So this kind of makes sense for you to have an understanding of. So you can see right here that the market actually continues to the upside, right? So this is a possible higher low right here. You can see the market breaking this, and we're having a little bit of discount right here. That means the market could actually be going to the upside by the reasons of the trend, right? So the trend is still to the upside. Now, what do we do on the daily time frame? What we do on the daily time frame is we use the daily time frame now to find the current trend of the market, and this is where it gets a little bit interesting, right? From the daily time frame, how do you identify the trend? You just want to see what is going on within the range, and it's very simple. You look at what the market is doing from the weekly range and the monthly range. You want to see what the market is doing in between. And what does it look like? The market is moving to the downside, and the market has been giving us some very beautiful higher highs and higher lows. And we have this low right here that refused to break, and the market is here. So the fact that you have this level as a higher low and this level where the market is rejecting on tells you something, that the market is on an uptrend. Then another thing you can use again is to confirm structures, right? Which is the daily time frame. So what is the structure within the range? You can see that after the market rejected this monthly higher low to this level, now the market started to drop down and it started to give us some sort of like lower highs and lower high structure, right? And the market started to give us, this could not form into a lower high. I explained this explicitly in my mentorship program. This is not a lower high. In this case, this is the last lower high, right? Because this just refused to break up below this level, right? So now, having these basic principles of structures really helps you clarify things, right? So we know for sure that the last lower high was here, right? And what has the market done? The market has broken that point right here. So in this case, this is a possible higher low, right? But this higher low has not yet fully formed because it needs to break this level as well. So the fact that the market broke at this level, right, tells us that the market is on an uptrend, with this level being the low, right? And this is a low, this is a possible low, and here we go. So now it's good for us to be able to identify the market from that point of view. Then another thing is, of course, when you identify that level of break, so now it becomes so easy for you to see what is going on within the range, right? So now we know that the market is also on an uptrend and the structures are to the upside on the daily time frame. So now we want to take a step even closer to look at what the market is doing. What is the current trend of the market? And this is what the daily time frame is used for. So to know the current trend of the market, you want to identify the major structures right here. Then we have this level. Then we have a situation whereby the market has been moving on this structure, hit this level, started to move on a downtrend, and guess what? The market changed structure here again. So to know the current trend of the market in this case, you can see that the market, even within this range, has been moving on an uptrend, moving on a downtrend. Now broke this level right here, and it is now moving on what seemed to be an uptrend, and that is it, with our base right at this level. So that means all of this zone right here are our level for base. So we've established the fact that by the reasons of structures, the market might just be on an uptrend, right? On the daily time frame. So what do we do on the 4 hours? The 4 hours, like I said, is used for finding key levels, right? Our area of interest. So in a case like this where we're looking to push onto the upside, so how do we find our point of interest? Is by just interpreting what is going on. So when the market rejected this level, we started to move on a downtrend, right? And the structure starts to align to the downside, and all of a sudden the market broke the structure to the upside, confirming that our daily trend has been established to the upside. Now, when the market breaks a structure, we don't just want to get in and just go on impulsive buying just like that. No, we want to wait for a discount so that we can be able to find specific pinpoint area where we're able to take advantage of this. And this is what the 4 hours is used for. You use the 4 hours to find those areas of interest. Now, this is where you start to scout for your trend line. This is where you start to scout for your trend line. If you're the trend line trader, right? This is where you start to scout for trend line and say, oh, the market after getting this one, touch 2, touch 3, depending on what you want to use. And for you to look for, areas of support and resistances, this is where you start to look for areas of support and resistances to back that out. If you're using indicators, your MAs, which I don't use, right? This is where you start to use that. But a very beautiful one that I love to use is the Fibonacci level, right? So I can see right here that I'm having a Fibonacci level right at this point. Now, this is the job of the 4 hours. The 4 hour time frame is going to give you all of this information, telling me that the most probable area of interest is around the 191.501 level, right? So this is where we go to the 1 hour, right? And before we get to the 1 hour, there's something that I didn't had, right? On the 4 hours, you actually use the 4 hours as well to look for your area of possible take profit, right? In this case, you can see we have a level right here. In this case, we have this level, right? We have this level. So what you use the 1 hour to do for basically is just to go and double check that and see that it's aligned with what you can see, because it brings more details, right? So look at it, right? So that means if we ever find a buy, you can see the take profit level, TP1, TP2, TP3 level. So now that we are on this point of interest, I'm just going to take this off. Now that we're on this point of interest, the job of the 1 hour is to test the integrity of that, right? To see if this level is going to hold by the reasons of, whatever is your execution strategy, right? At this point, you want to be able to look for it, right? For me, I love to see a very clean structure change for me to be able to, find that, right? So the 1 hour is where you use to kind of bring that together, right? So in my own case, I want to see, okay, where is the market reacting right now? I can see that the market has been moving in this way and form, and now the market is kind of breaking right here to my point of interest. So I want to see, this is where I start to look at the behavior of the market to see what the market is going to do, right? And all I have to do once I find the information I'm looking for, perhaps maybe the market has to go up and, come down to this level and break to the upside. Perhaps if the market have to do that, or my trend line confluences as the case, this is where I now start. The moment the market gives me a very clear story, this is where I go to the 30 minutes to wait. And for my execution, I'm only waiting for a break and close for me to have a confirmation for me to execute. So when that happens right here, right, and this is where I execute, I really use the 15 minutes time frame too, but I use it side by side with the 30 minutes, right? So if I'm going to be using the 15 minutes time frame, I have to be watching the 30 minutes as well to make sure I'm not faked out. So let me give you a realistic scenario, right? So let's assume, hypothetically speaking, that the market comes back to this level to test this and then comes to this level right here and start to move on a very strong push to this level. Now at this level, this is where I go on my 30 minutes and 15 minutes time frame. All I'm waiting for is to see if I'm going to find a break right here and keyword close. Always wait for your close, right? Then I start to compare 15 minutes time frame, 30 minutes time frame. So this is the point where I use for my execution, right? And in the case of execution, of course, you want to know the right place to put your stop loss. That's not the subject of this of this video. But yes, every stop loss as a rule of law should be kept behind the last low that the market broke, right? So this is where I want to be able to see what the market is going to do, so in this case, if I ever find a break above this level, this is where I want to come to this level. Then I want to have my take profit 1 right here, take profit 2, or perhaps when that close happen, right, this is where I want to wait for like a discount, right, to this level. I'm just buy most likely, so that I can have even way much more better risk reward. And this is where I'm going to be setting my take profit, which the take profit level which I've gotten from my 4 hours time frame. I want to set it right here. I want to extend it as the case may be, and the goal is for me to just put it at the most reasonable point where the market is just easily going to take me out, so that I can count my wins and not just overstay in the market. So I might look for TP1. If the market hit the TP1, this is where I get a break even or take out profit and just keep trailing my stop loss. TP2 keep trailing, and TP3 keep trailing. So this is how to use time frames to your own advantage, right? I want you to watch this video 2, 3, 4, 5 times. Come back to it again and again whenever you have this analysis paralysis. It is very important as traders for us to have clarity of what we want to do with different time frames. It is very, very important. I cannot emphasize it less. Okay, once you have a clarity of what you're looking for in each time frame, all you have to do is simple: look for it, right? And this is going to save you so many long hours of analysis paralysis. Okay, and perhaps some of you still want more. You love this whole concept, you love how we simplify it. I definitely recommend that you go to www.SwingTradeFX Academy, and you can just go for the freedom course right here, and you can just sign up with us, and we are going to be reaching out to you via our mail. So thank you guys so much. I hope this video helps you, and I hope you can go on your chart and practice it. It's not about just consuming this content, it's about applying it for your own personal advantage. And perhaps some of you guys have your strategies and you're already good and you just need some fine-tuning. You can go into the book now to book me for a one-on-one mentorship session. So thank you guys so much, and I hope you enjoyed this video, and I will see you on the next. God bless you.